Chapter 13, Return, Risk, and the Security Market Line. I often call this chapter Expected Risk and Return. Okay, so this is the outline of the chapter. Let me just move on to what this chapter is mainly about. First, we will look at some math, how we calculate the expected return and expected risk of returns for a single asset. For example, buying shares of stock from one company. And then we will do that for a portfolio of assets. For example, buying shares of stock from 2 different companies or 3 different companies or even more. Then we will look at a related topic known as diversification. So what is meant by diversifying your investment? Then we will look at the risk in more depth. So it turns out there are several different types of risk. And then we will look at, kind of go back to the whole risk and return trade-off, something that already came up in our previous chapter, chapter 12, where we looked at historical returns. So first, let's compare this chapter with the chapter we did before this one, chapters 12 and 13. In chapter 12, we were basically looking at historical data. So we were talking about the past. We looked at historical returns, which were all known, so there was no such thing as uncertainty about what may happen, because it already happened. And this is something that will be different when we talk about the future. The future is uncertain. Then we'll calculate the average return, which we denoted by R bar on top. And we also calculated the standard deviation of past returns, which we denoted by sigma. And sigma squared was variance. In chapter 13, we will be looking at future returns. So the main difference between chapters 12 and 13 is in chapter 12, we looked at past returns that already happened. In chapter 13, we will be basically trying to give our best estimate based on the information that's available to us today about what the return in 1 year, in 2 years, and so on may be. The future is unknown, so the returns in the future are also unknown. So we have this uncertainty about what may happen in the future. And because of the uncertainty, we will be talking about probabilities. So for example, we will be talking about something like most probably, so let's say with a 90% probability, right? So and so will happen. So let's say the return will be 15%, just like it's been in the last several years. But maybe there's a small chance, let's say 9% chance that things will go much better for the company. And maybe the remaining 1% chance is in case something really unexpected bad may happen to the company whose shares we are buying now, that will result in little to no dividends to us. So we will be talking about different outcomes that may happen and how likely, or the probability for each. And in terms of the calculations, we will be essentially doing the same 2 sets of calculations like we were in chapter 12, except we will be doing expected return and we will denote it by capital E brackets with capital R inside the brackets. So E stands for expected, R is return. And we will be also calculating the expected standard deviation of future possible returns with the notation being capital E, and then in the brackets we have the Greek sigma. Okay, so when we talk about the future, we always deal with uncertainty, right? Because nobody knows what will happen. And so next we will be looking at how we would be calculating next year's expected return and expected variance or expected standard deviation, which is simply the square root of variance. In real life, we cannot really predict the future, And so when we're trying to predict something for, let's say, next year, once 1 year has gone by, we will realize that we made a mistake. We are always going to be making mistakes. So generally, actual returns are not equal to what we expected them to be. And we say that actual return, capital R, has two components. What we thought it would be, or the expected component, E, and in the brackets R. And the second component is what we did not expect to see, the unexpected component, which we denote by capital U. So mathematically, it's as if we have R, that's the actual return, equals E in brackets R, expected return, plus capital U, the unexpected return. Let's look at an example. So this unexpected return can be either positive or negative. For example, let's say a year ago, we expected the return over the year to be equal to 15%. So this is the expected return, what we thought it would be. But 1 year later, so since our last year's prediction, 1 year went by, we are now today, and we can actually observe what we received from the company, which translates into some percentage return. And let's say that actual return is now 12%. So what does it mean? We thought the return would be 15%, but it ended up being lower than that, only 12%. It's 3% lower. So we say that the unexpected return component is negative 3%. Negative means that we received less than we expected, right? So we overestimated our return. We were too optimistic. Or let's look at the second example. Maybe we expected the return to be 11%, but the actual return is now 12%. So we were maybe too pessimistic, or maybe for whatever reason, we didn't expect to earn such a high 12% return, and our expectation was to increase the value of our investment by just 11%. So we did better by 1%. We did 1% better than we thought we would. So we have the unexpected return component equal to 1%, which is positive. So positive means we did better than we expected. Negative means we did worse than we expected. It's also probably reasonable to say that we're always going to be off, either overestimating or underestimating how much we will earn on our investment. So over time, over many years, right? So as we keep kind of estimating our future returns, the unexpected return component on average will equal 0. So 0 means that we are never consistently optimistic or pessimistic. We are always kind of reasonable in making our predictions about what we think will happen in the future in terms of how high of a return we may earn. But sometimes we will be underestimating, sometimes we will be overestimating. And on average, we will sort of kind of break even. On average, our error will be 0. And that's because all negative and positive components of the actual return will basically cancel each other out. Question: what do the expected and the unexpected components of return depend on? Well, this is directly related to the last topic, conceptual topic in chapter 12, at the end of chapter 12, called market efficiency. So it was all about what makes stock prices fluctuate, go up and down all the time. And that was information, because of any new information that comes in. Like a company posts on his website that it has just made a deal with another company to merge or something like that. So anything like that, whether it's good or bad, a good or a bad announcement, it will immediately affect what investors think about where the company is heading in the future. If they think that it's a positive news, then they will be willing to pay more money to buy the shares of stock, right? Or maybe we can say it differently. They would expect that the company will be more profitable and make higher profit every year, which will allow the company to pay higher dividends to investors. So maybe all of that information is what, actually not maybe, this is exactly how the expected return component is determined. So the expected component of return, E and R in the brackets, depends on investors' information about the stock and on their understanding today of the important factors that will influence the stock next year. What about the unexpected component, the capital U? That's that's the error we're gonna make, right? How much off we will be when we are at that point of time in the future for which we were trying to estimate the stock return, and realize that okay, we are off, we overestimated or we underestimated. So why would that discrepancy in the between the expected and the actual returns be? It would happen because of any new information, such as announcements, news, etc., that would be revealed between today, when the prediction is made, and next year, for which we were trying to make the prediction. And it will change the stock return next year, which was previously unanticipated. Okay, now let's look at some math. Let's look at the math behind calculating expected return. So here's how I would like to explain like the whole, thing with probabilities and different possible scenarios, something that comes up in stat classes all the time. This is how I would explain it in the context of stock returns. So let's say you believe that next year's returns for some company's stock will be similar to what they were like over the last 10 years, right? So you're kind of saying that, okay, let's just, extrapolate the trend from the last, most recent years and say that, okay, it's going to be roughly the same as it was in the last several years. We're going to see something similar to that in the next couple of years. So let's say we are looking back at the last 10 years, between 2009 and 2018. And the returns were 2%, then 5%, then 2%, then negative 1%, 5%, 2%, 2%, 2%, 5%, minus 1%. I kind of placed them more or less randomly. The question is, what will be the return in 2019, 1 year in the future, in 2020, in 2021? Can you use this past information to give you best guess on future returns or on the expected returns for the next few years? Let's start with the following. Over the last 10 years, what was the chance of getting a 5% return on your money, or a 2% return on your money, or losing 1% of your money in 1 year? The chance of getting 5% is, so that happened 3 times in 3 different years, in 3 out of 10 years. 3 out of 10 years equals 3 divided by 10, or 30%. So there was a 30% chance of making 5% more money on your stock investment over 1 year during the last 10 years. Similarly, what was the chance of getting a 2% return on your money? Well, again, let's count how many times over the last 10 years we had the return of 2%. 1, 2, 3, 4, 5. In 5 out of 10 years. That's a 50% chance. And then we have 20% of something else happening, which is correct because in the remaining 2 out of 10 years, you saw a loss of 1% of your money, negative 1% return. So in 2 out of 10 years, the return was negative 1%, and it was a 20% chance. And all 3 chances for these 3 things that were happening add up to 100%. So, make sure you realize that all chances, all combined, must add up to 100%. 100% chance means something will happen. Next question. What is your best guess for the returns in future years? It probably makes sense to say that whatever the return we expect to get in the year 2019 will reflect what occurred in the last 10 years. So kind of 3 out of 10 portions of the return will reflect the 30% chance of getting a 5% return. 5 out of 10 portions of it reflect a 50% chance of getting a 2% return. And the remaining 2 out of 10 portions will somehow contain the information on the possibility of losing 1% of your money, right? And we can kind of say the same for any year in the future. Maybe nothing too distant in the future, but maybe the next 2-3 years. So the same for year 2020 and year 2021. And now, how do we put it into a formula? So how do we calculate that one number that reflects everything that happened over the last 10 years in this example? We calculate the expected return by multiplying the chance of receiving a 5% return, which was 30%, by 5%. Then we add the chance of receiving a 2% return, which is 50%, by 2%, the product, right, of the two. And then we add the product of the chance of losing 1% and a negative 1% return. So 30% times 5% plus 50% times 2% plus 20% times negative 1%. And that equals 2.3%. That's our expected return for year 2019, and you can probably say that that's also what you expect in the couple of years after 2019. In this expected return calculation, you can also write everything in decimals. 0.3 times 0.05 plus so on. It doesn't really matter. Another question. What was the average return over the past 10 years? Well, the average return is just the simple average, right, of those 10 numbers that we were given. If we add them up and divide by 10, we get 2.3%. Where else did 2.3% come up? It came up when we were calculating the expected return. Is it a coincidence? No. They will be the same because this is how we were calculating the expected return. We were using the probabilities for each possible outcome. Outcomes being what we can earn, 5% or 2% or negative 1%. And the probabilities, they kind of, the 30% probability, it's like in the historical average, adding 5% 3 times, right? 5% in 3 different places. Same for the 2% outcome. 50% chance means if we are talking about a 10-year period, then it's 5 times over 10 years. And in the historical average return, we have 2% summed up 5 times. And we only have a negative 1% 2 times in the historical average return formula. So this slide kind of illustrates that the expected return, it's kind of like the simple average of all possible returns. In this example, 5% or 2% or minus 1%. Correctly accounting for how often, this or that return would be occurring. We can also say that we will get a 5% return randomly in the next 3 out of 10 years. So between the year 2019 and 2028, over those next 10 years in the future, we will randomly get a 5% return on our money in 3 years. They don't have to be consecutive 3 years, but they will be, sometime randomly over the next 10 years. Also randomly in the next 5 out of 10 years, we will make only a 2% return. And randomly in a couple of years, out of 10 years in the future, we will lose 1% of our money. So it looks maybe a little bit complicated, just the kind of math that went into calculating the 2.3% expected return. But this is my way of explaining like the whole, what's possible and how likely it is to occur. In this class, you won't be ever doing this kind of math. Instead, if I go back to this slide where I was calculating the expected return, instead, you will be given the probabilities. You won't ever need to derive them. And you will be multiplying the probabilities by the possible returns, which is also something that will be always given, if the question is to calculate the expected return. So you will be basically given all these numbers, the chances or probabilities of something, and what could actually occur, the possible returns. So to summarize, expected is kind of like the average, is nothing but the average, if the process will be repeated many times. So the expected return does not have to be a possible return. It's more like an average of all possible returns. In this example that we just looked at, we had 3 states of the economy. That's the term often used in finance to mean the same thing as outcome or an actual event that may occur. What were the 3 states of the economy in our example? The first state of the economy was getting a 5% return, and the probability of that was 30%. And the second and the third states of the economy were getting a 2% return or getting a negative 1% return. And their respective probabilities were 50% and 20%. The word probability is the same thing as a chance of something, or how likely that particular outcome is. In finance, it's common to give names to the states of the economy. For example, we can call the 3 states, let's say, boom, normal, and recession. Maybe we have a company called ABC, and we are trying to estimate the return on its stock next year. And let's say we identified 3 states of the economy, making a 35% return, which we call the boom state, making a 12% return, which we call a normal state, and losing 3% of our money, which we call a recession state. Or maybe we have a different company, XYZ, and we are also trying to estimate its return for next year. And before we do any calculations, we identified that there are 2 possible outcomes or 2 possible states of the economy, and their names are good and bad. In the good state of the economy, we're going to make a 15% return on our stock investment. If the state of the economy will be bad, then in that scenario, in that state of the economy, we will only make a 4% return on our money. Now, the second thing that we will be talking about is how likely are the states of the economy that are given to us, because there are kind of two things that are happening at the same time. States of the economy is one, some returns, right, in percent, and their probabilities, also in percent. So two sets of percentages, returns and their probabilities. So the states of the economy can be equally likely or not equally likely. What would equally likely mean in the example we just looked at with the boom, normal, and recession states of the economy? Equally likely would mean that all three states of the economy will happen with the same exact probability. So the chance of something happening is 100%. If we divide 100% by 3, we get 33.3% of boom, of normal, and of recession. In the other example with just two states of the economy, good and bad, if they're equally likely, then it's a 50-50 chance. So 50% getting a 15% return, the good state of the economy, and a 50% an equally likely, right, possibility of making a 4% return, the so-called bad state of the economy. So again, whether the states of the economy are equally likely or not equally likely, the important thing is that all probabilities must add up to 100%. So if somehow they do not, then you probably have a mistake somewhere. This is the big picture of the calculations we will be doing next. We will be looking at two cases. Case one, you buy shares of stock from just one firm. And for that case one, we'll be calculating expected return and expected variance and expected standard deviation when the states are equally likely, or if the states of the economy are not equally likely. Case 2 will be calculating the expected return, expected variance, and expected standard deviation when you're investing your money into stocks of two or more different firms, which is what the term portfolio means. And again, for case 2, we will be doing the calculations when the states of the economy are equally likely and when the states of the economy are not equally likely. So this is the big picture of the math we'll be looking at next. And this slide is the summary of the formulas we will be using. To find the expected return, we will take the probability of the first state of the economy and multiply it by the return in the first state of the economy. Then we will add the probability of the second state of the economy multiplied by the return in the second state of the economy. And we will keep adding those products until we have covered all possible states of the economy. The expected risk, variance, and then the standard deviation, which is the square root of variance. Variance, as always, can be denoted by sigma squared, except in this chapter it would be expected variance of returns. The formula is similar to the expected return formula, except where you would multiply by the return to find the expected return. Now, for the variance, you would be multiplying by the squared difference between the return in that state and the expected return. So it's the expected squared deviation from the expected return. Don't worry if you're kind of getting lost with these formulas, because we're going to look at a whole bunch of numerical problems where we will be, plugging in the numbers into these formulas. Okay, so let's start with something simple. You're buying shares of stock. It doesn't matter how many, but what matters is that you're buying them from just one firm. So let's say based on historical annual returns and everything you know about the company as of today, you figured out that the following scenarios or states of the economy are possible for next year. With a 33.3% chance, it will be the so-called boom state, in which case you will make a 28% return. With a 33.3% chance, there may also be a normal state of the economy, in which case your return will be 12%. And with the remaining 33.3% chance, the state of the economy will be called recession, and that's when you will lose 7%. Because the three probabilities of the three states of the economy are equal, we call them equally likely states. So let's calculate the expected return and then the risk. And for the expected risk, we will first calculate the variance of the returns and then their standard deviation. To calculate the expected return, we go through all the states of the economy that are given to us. In this problem, we have three: boom, normal, and recession. So for the boom state of the economy, we multiply the probability by the return. You can do it in decimals, for example, although it doesn't really matter. In decimals, you would do 0.333 multiplied by 0.28. Then you add the same product but for the normal state. The probability times the return, 0.333 times 0.12. And then finally, you will add the product for the last state of the economy, the recession. The probability of recession times the return in recession, 0.333 times negative 0.07. The sum of these three products covering the three states of the economy gives 0.11, which is an 11% expected return. So you can think of 11% being something like the average return over the next, let's say, 10 years. So over the next 10 years, sometimes you'll be getting a 28% return, sometimes a 12%, sometimes a negative 7%. And they'll be randomly repeating, right? These three numbers over the next 10 years. If you kind of draw a line between these three, returns, kind of the dots jumping up and down, the line will be going through 11%. And the meaning of it will be on average, your return on average. How do we calculate the variance? It's very similar to the expected return formula if you compare them. So for the boom state of the economy, we multiply the probability of the boom, 0.333, by the squared distance from the expected return, 0.28 minus 0.11, the difference squared. And then we add the same product of the probability and the squared distance from the expected 11% return for the remaining two states of the economy, for normal and recession. The resulting variance in decimals is 0.020467. When we take the square root of that, we get the standard deviation of future returns, which is 0.1431 or 14.31%. How can we summarize what we know about this company stock? We can say that if we buy this stock today, then you can say that you expect to make an 11% return every year. It's like saying that on average, your money will be growing by 11% in the future, every year. But you will never actually get 11%, right? Because what you will actually be getting is one of these three given returns, 28% or 12% or minus 7%. So you can then add a second sentence which says, however, the actual return that you will be getting will be on average 14.31% either above or below the 11% expected return. So the standard deviation 14.31% shows the magnitude of the fluctuations of the actual returns, how far apart they will be in the future from each other. Well, actually not from it, well, kind of from each other, but it's more like average distance from 11%, either above or below. Let's change this problem a little bit. We have the same three scenarios: boom, normal, recession, the same possible returns in each state: 28%, 12%, minus 7%. But this time, the three states of the economy are not equally likely. The boom state will happen with a 10% chance. The normal state of the economy is the most likely scenario. It will happen with a 60% chance or probability. And the recession scenario will happen with the remaining probability, which is 30%. So the three probabilities are given and the returns are given. If you do the math, then the only thing that will be different is what I'm highlighting in the red color, the probabilities. We will no longer have 0.333 for the expected return and for the variance formulas. Now there will be 0.1, 0.6, and 0.3. And that, of course, will affect the results that you will be getting. Now, the expected return will be 7.9%. And the standard deviation will be 10.82%. So we can say that on average, you're expecting to make a 7.9% return on your money every year in the future, but the actual returns you'll be getting will be on average 10.82% away from the 7.9% average in either direction, either above or below 7.9%. You can do the calculations with all the returns and all the probabilities in decimals or in percent. Just pick one and use it throughout your calculations. Stay consistent. For example, if you use your returns in decimals, then your answers will be 0.12 for the expected return and 0.35 for the standard deviation. If you instead used your returns in percent, then the same calculations will instead give you 12% for the expected return and 35% for the standard deviation. In the next examples, we will compare investments into two different stocks. Okay, and we will again stick to three possible states of the economy: boom, normal, recession. In some problems in this class, for example, in the homework assignments, you may see only two states, let's say good and bad, or boom and recession, or three states, or four states. I don't think I recall seeing more than 4 states of the economy, although you can technically have as many states of the economy as you like. Okay. So let's look at this problem. We have a 20% of the boom state, a 50% of the normal state, and a 30% of the recession state. The return on stock of firm A is 30% in the boom, 12% in normal, minus 10% in recession. The return on the stock of firm B is minus 5% in boom, 7% in normal, 15% in recession. Separately, let's focus on stock A and calculate its expected return, variance, and standard deviation. And then we do that separately for stock B. For stock A, just like in the earlier examples, we would need to look at the boom state and multiply the probability of the boom state by the return on stock A in the boom state. In decimals, that's 0.2 times 0.3. Then we add a similar product for the normal state. The probability of normal is 50%. The return on stock A in the normal state is 12%. So I'm adding 0.5 times 0.12. And then I'm adding the same product for the recession state. 30% probability, or 0.3, multiplied by negative 10% return, or negative 0.1 in decimals. The sum of these three products gives me 0.09 in decimals, or a 9% expected return. So I'm expecting my money to grow on average by 9% every year in the future, based on what I know about the possibilities and how likely they are. Then, using the formulas from before, I can calculate the variance of stock A returns, which gives me 0.0201. The square root of variance gives me the standard deviation for stock A, 0.1418 in decimals, which is 14.18% standard deviation. Then I need to do the same math but for stock of company B. So what information will I need to use? The first column, the probabilities of boom, normal, and recession, 20%, 50%, and 30% respectively, and the information on stock B. I don't need the information on stock A. For stock B, minus 5% in boom, 7% return in normal, 15% return in recession. So just like I did it for stock A, I'm multiplying the probability by the return in that same state of the economy, and then I'm adding those products across all states, which gives me a 7% expected return. The variance is 0.0048 when I use all numbers in decimals, and the square root of my variance is 0.0693 in decimals, which is 6.93% standard deviation. Okay, so let's answer the following question. Which stock would you say is more attractive to investors, stock A or stock B? Usually the answers here are it's stock A because you make on average more money, and that's true. Your expected return on stock A is 9%. Your expected return every year on stock B is 7%. So 9% is better than 7% for the expected annual return. However, you can also compare the amounts of risk of the two stocks. If you compare the values we got for the standard deviations. So the standard deviation for stock A is 14.18%, and the standard deviation for stock B returns is only 6.93%. Which one is better? It's lower for stock B, which means lower fluctuations in actual returns, which means less uncertainty about what the return may be every year. So the returns are kind of closer together, right? You can almost see it if you look at the table with the given information. The returns on stock A are kind of much wider apart. So the range goes between minus 10% and 30%. Whereas on stock B, the range is between minus 5% and only 15%. So the three returns on stock B are much closer together than the three returns on stock A. And mathematically, we can, prove that by calculating the standard deviations and double checking that it is a smaller number for stock B than for stock A. And so overall, which stock would you buy? A, with the better return but a worse amount of risk, or stock B, with a lower return but a much better, lower amount of risk? There is no correct answer to this kind of question. It's basically up to you. It's a matter of personal preference, whether you're okay with, your money going up and down by a lot every year, but on average, you're guaranteed a better, increase in your money every year, or whether you are a more risk-averse person. So you don't want your money to fluctuate too much. You prefer a lower standard deviation. But of course, if you don't risk, you don't win, right? If you're not taking your chances, then you will not be rewarded with a high return. And your return every year on average will be only 7%. Next, let's look at the same calculations: expected return, expected variance, expected standard deviation of returns for a portfolio rather than an individual security. So what exactly do we mean by portfolio? We mean two or more financial securities. Do we mean 2 shares of stock of the same company? No. It's not 2 or more shares of stock from the same company. It's more like stocks from at least 2 different companies. It doesn't matter how many stocks of each company you're buying. As soon as you're buying stocks from different companies, you have a portfolio. Or maybe a different example: you're buying a few stocks and you're also buying a few bonds. These are 2 different financial securities, and buying both means buying a portfolio. One more new sort of layer of information, numerical information, that would need to be given or calculated based on something that's given in order to do the calculations of expected return, variance, and standard deviation is what we refer to as weights. So we need to know the weights of stocks or stocks and bonds in our portfolio. Let me skip this slide. These are just general formulas that we will be using for a portfolio. For the most part, they are exactly the same as for an individual stock. Okay, let's look at the following example. In this example, the question is to calculate the weights of 2 stocks. So you're buying shares of stock of company Y and shares of stock of company Z, Y and Z. You're buying 100 shares of stock Y. Each share costs $90. And you're buying 300 shares of stock Z. Each share costs $75. So 100 shares of stock Y, 300 shares of stock Z. What are the weights? In which proportions are you buying shares of stock from Y and Z? So if you take 100 shares of stock Y, divide by a total of 400 shares that you're buying from both companies, you get 1/4. And so the weight of stock Y is 1/4, and the weight of stock Z is the remaining 3/4, right? Actually, this is wrong. What's wrong is that you need to also take into account the fact that some shares may be more expensive than other shares. So if you're buying a lot of shares with each share being very cheap, then it's like you're not really investing that much of your dollars into that company's shares, right? So all of that needs to be accounted for. And the correct way of doing the math is the following. Think about how much money, rather than purely the number of shares, how many dollars goes into stock Y shares total. 100 shares times $90 per share equals $9,000. Then, how much money goes into stock Z shares? 300 shares times $75 per share equals $22,500. How much money total do you invest into both companies' shares? $9,000 plus $22,500 gives $31,500. That's your total investment. And only then can we calculate the weights of Y and Z in the portfolio. And the way we do that, we are calculating the relative proportions or percentages of stock Y and stock Z investments out of the total. So the weight of stock Y is the total of $9,000 invested into stock Y shares divided by our total investment, $31,500, which gives 0.2857, which is the same thing as 28.57%. The weight of stock Z is the rest, which we can also calculate the same way. $22,500 total invested into stock Z shares divided by our total investment of $31,500. This gives 0.7143 in decimals, which is 71.43% of our money. You can also notice that we could get 71.43% by simply taking 100% and subtracting the weight of stock Y, minus 28.57%. Let's look at another example in which you're asked to calculate portfolio weights. Here we have 4 different companies, and we are buying shares of stock from each of them. We are not given the number of shares and the prices per share. Instead, we are given the total amounts of money that we spend to buy the shares of stock from each of these companies. $2,000 of Starbucks stock, $3,000 of American Eagle stock, $4,000 of KFC stock, $6,000 of Abercrombie & Fitch stock. What are your portfolio weights in each security? So remember, we need to calculate the weights based on the total amount of money that was invested in the portfolio. What is the total? 2,000 plus 3,000 plus 4,000 plus 6,000 gives $15,000 total invested. And then we can proceed to calculating the weights, the 4 percentages, which must add up to 100%. The weight of Starbucks stock in the portfolio equals $2,000 invested into Starbucks stock divided by a total of $15,000 invested into all 4 stocks. This gives 13.3%. The weight of American Eagle stock in the portfolio equals $3,000 divided by $15,000. That's a 20% weight. The weight of KFC stock in our portfolio is $4,000 divided by $15,000, which gives 26.7%. And the weight of Abercrombie & Fitch stock in our portfolio is $6,000 divided by $15,000, which gives 40%. And the 4 weights, the 4 percentages, do add up to 100%. So make sure they do in case you're dealing with weights, because otherwise, if they don't, look for a mistake somewhere in your calculations. Now let's look at a complicated problem in which you are investing 50% of your money to buy stock A shares and the remaining 50% of your money to buy stock B shares. These are the weights, 50% and 50%. They're already given. Then let's look at the same exact information that we had on one of the earlier slides in this chapter, where we were comparing stock A and stock B. So we have 3 states of the economy: boom, normal, recession. The probabilities of them are 20%, 50%, and 30% respectively. The return on firm A stock is 30% in boom, 12% in normal, minus 10% in recession, and the return on stock B is minus 5% in boom, 7% in normal, 15% in recession. Earlier, we calculated the expected return for A and B. For stock A, the expected return was 9%. For stock B, the expected return was 7%. Okay, so we want to calculate the portfolio return, expected return on the portfolio, expected variance of portfolio returns, and expected standard deviation of portfolio returns. The same exact things we were calculating for a single stock. Now, we are not buying a single stock. We are buying two stocks from two different companies, A and B. Here's how we can approach this problem. We can add an extra column to this table in which for each state of the economy, we are calculating the return on the entire portfolio. How are we going to do that? So we can do the following. If we bought just stock A, we would get a 30% return in boom. But we don't spend all 100% of our money into stock A purchase, only 50%. So we're going to earn 50% of 30%. Then we don't spend all of our money on stock B either. So we're not going to lose 5%, but because we only invest half of our money, we're going to lose half of 5%. So we have 0.5 times 0.30, that's for stock A, plus 0.5 times negative 0.05, that's for stock B. And this gives us 12.5%. That's the return from both A and B, the entire portfolio, in the boom state of the economy, if the boom state occurs, if the first row in this table occurs. The same way we can calculate the portfolio return in the normal state. So half of our money will increase by 12%, and half of our money, so by half I'm referring to the weights of A and B that are given in red, but half of our money is going to increase by 7%. So mathematically we have 0.5 times 0.12 plus 0.5 times 0.07 equals 9.5%, right? So we are going to increase our money by overall 9.5% if the normal state of the economy is what takes place. And then if instead the recession is what actually occurs, then we are going to make a 2.5% return on our portfolio, which is calculated by multiplying 0.5, the weight of stock A, by minus 0.1, the return on stock A in recession, plus the weight of stock B, 50%, times the return of stock B, 0.15, in the recession state. Okay, so if you look at this column that we have just created, we have 12.5% in boom, 9.5% in normal, 2.5% in recession. These are the three possible returns on the portfolio. Now treat these three possible returns as your new starting point. How would you calculate their expected return? Same as what we were doing for a single stock on one of the earlier slides, or on many of the earlier slides, right? We had several examples. We take the probability 20% of the boom state and multiply by 12.5% return on the portfolio in the boom state, plus the probability of the normal state multiplied by the return on the portfolio in the normal state, plus the probability of the recession state, 30%, multiplied by 2.5%, or in decimals 0.025, the return on the portfolio in the recession state. The sum of these three products gives us an 8% expected portfolio return. This is one way you could calculate portfolio expected return. There is a completely different way. Remember earlier we already calculated that the expected return on just stock A is 9%, and the expected return if you just buy stock B is 7%. Because you're buying them like equally with your money, so half of your money buys A, half of your money buys B, then intuitively it makes sense to say that overall your expected return on A and B combined will be halfway between 9% and 7%. In other words, the math you could do instead is take the weight of stock A, 50%, and multiply by the expected return on stock A, 9%. And then add the weight of stock B, 50% in our problem, multiplied by the expected return on stock B, which is 7%. This calculation again gives you an 8% expected return on the portfolio. So there are two ways of doing the calculations. It doesn't matter which one you do. Both require the same amount of work. Even though the second method seems much faster, keep in mind that we are not given the 9% and the 7% expected returns on A and B. You have to calculate them first. So whichever way you do it, you will be doing the same amount of work. So it's just whichever method you find more intuitive. Although I would like to add that you do need to understand both, because there are some problems in which you have to use the second method, because based on what's given, you are already given the expected returns on the individual stocks in your portfolio. In that case, you have to use the second method. So keep in mind that, both methods should be equally, understood by you. Next, let's calculate the expected variance, sigma squared, and the expected standard deviation, sigma, of this portfolio. Because we are treating the portfolio returns in boom, normal, and recession as if it's just, a fresh problem for some one asset, we can apply the same exact formulas as we used for a single stock in earlier slides. So we do the probability of the boom state, 0.2, multiplied by the return on the portfolio in the boom state, 12.5%, minus portfolio expected return, 8%, that we have just calculated on the last slide. And then we square that deviation from 8%. Then we add the same thing, probability times the squared deviation for the portfolio in the normal state, and then the same thing one last time for the recession state. This gives us the portfolio expected variance. In decimals, it's 0.001425. The square root of that is the portfolio expected standard deviation of returns, which is in decimals 0.0377 or 3.77%. How would we summarize the information we obtained on this portfolio? We can say that if you buy both company stocks in equal dollar amounts, right, stock A and stock B shares in equal total dollar amounts, then you expect to grow your investment by 8% every year in the future. However, your actual portfolio returns will be fluctuating. They will not be 8%, as a stable increase per year. They're actually going to be fluctuating around 8% average growth by, on average, 3.77% in either direction. either above 8% or below 8% by 3.77% on average. There's another thing you may notice in this last problem. The portfolio fluctuations or risk was 3.77%, right? However, for the individual stocks A and B, like we saw, let's see where we saw it. We saw it slide 24. The standard deviations of the two individual stocks A and B were both above the portfolio standard deviation. And this should kind of look very strange, right, at the first glance. Like, why wouldn't portfolio risk be also halfway between the individual stocks risk levels, just like we saw with the expected returns? Well, this is something strange that happens, and there is actually an explanation for it. We call it the diversification effect. It doesn't always happen, but in the example we looked at, it's very, very obvious. The idea is, let me just go back to what we were given. Let's say here, slide 30. Do we ever lose money if we buy just stock A? All of our money is spent on stock A. Yes, we may lose 10% of our money if the so-called recession outcome takes place. Can we lose money if we just buy stock B? Again, the answer is yes. We can lose 5%. Every now and then, there's a 20% chance of losing 5%, like 1 in 5 years, if the boom year occurs. Now, my third question is, can you lose money if you buy both A and B? Well, let's look at the portfolio returns. 12.5%, 9.5%, 2.5%. No, we can never lose money. That's great, right? So why can we never lose money? And why do we get... Okay, so let me just answer this question. Why can we never lose money? Look at what has happened. Whenever we would be losing money on stock A, we're going to be offsetting the loss with stock B gain, right? We're never going to lose 10% because even though half of our money loses 10%, the other half makes 5%, right? Then we're never going to lose money in the boom state because even though half of our money loses 5% from stock B return, the other half of our money would gain 30%. So the losses are always offset by the gains, right? In all, individual states of the economy. That's what we mean by this diversification effect, right? It's good to buy stocks with returns that are sort of inversely related. Whenever the return is low on one stock, it's high for the other stock. For example, in the boom state, the return is negative for B, but very high in A, highly positive. And in the recession state, the return is negative for stock A, but it's positive and very high for stock B. So A and B are kind of helping each other. They're offsetting each other's losses with the gains. And this is why we're never going to have this wide range of returns that we see for stock A or for stock B. The portfolio returns are going to be sort of much closer together, resulting in no possible loss ever. That's the diversification effect. Let's look at one more numerical example, which explains the diversification effect. We want to invest money into a portfolio of two stocks, A and B. We have two states of the economy this time, boom and recession, and they're equally likely. So the probability of each is 50%. Stock A, 25% return in boom, negative 15% return in recession. Stock B, 10% in boom, 90% in recession. Normally, we would be also given the weights of A and B. We don't know the weights, we just know the returns and the probabilities of the possible outcomes. So what are we going to do about the weights? Let's calculate the expected return and the standard deviation for 5 different combinations of weights. In other words, for 5 different portfolios. The first portfolio is 100% invested into A and 0% into B. In other words, all of our money goes in buying A. So B is not even in the picture. The second portfolio is 70% of money invested into A and then 30% into B. The third portfolio is equal weights, 50-50. The fourth portfolio, 30% in A and 70% in B. And the fifth portfolio, 0% of money invested in A and 100% of money invested in B. Essentially, we're going to be doing a lot of repetitive calculations. They will be very similar. We will be just changing the weights throughout all the calculations. Okay, so let's start with the first, top left cell. So the first row, the first entire row is the first portfolio, in which 100% of our money is invested into A. Essentially, it means just A. And then the next rows are the other 4 portfolios. So what are we going to be doing for each row, for each portfolio? Return on the portfolio in the boom state, return on the portfolio in the recession state, expected return on the portfolio, and then portfolio variance and portfolio standard deviation. The last row is the fifth portfolio, which is 100% stock B. So that's just stock B, right? Okay, how would we fill out the top left cell in this table? Return the portfolio in the boom state. If it's just A and we're just looking at the boom state, then it's just 25%. But more generally, we would be using the weights. So in decimals, 100% is 1 and 0% is 0. So weight of stock A, 1, times the return of stock A in the boom state, 25, plus weight of stock B, 0, times return of stock B in the boom state, right? This gives 25%. The same way we can recalculate the return on the portfolio in the boom state for all remaining portfolios. And the first column is done. So notice that what stays the same is the information for the boom, right? 25 for stock A, 10 for stock B. So we see 25 and 10 in every cell in the first column. But what changes is the weights. We started with 1 and 0. Now we have 0.7, 0.3, then 0.5 and 0.5, then 0.3 and 0.7, and 0 and 1. And the portfolio returns in the boom state become, starting with the top row, 25%, 20.5%, 17.5%, 14.5%, and 10%. They're kind of going down as we are lowering the amount of stock, stock A, which has a high return, and increasing the amount of stock B, which has a low return. So overall portfolio return in the boom state goes down. The same way we can calculate the portfolio return in the recession state. If we do exactly the same calculations as we did for the boom, but only update the numbers from the table that was given to us, and pick the returns for the recession state. So for example, if you look at 30% A, 70% B, the second from the last portfolio. Then to calculate the portfolio return in the recession, we take 30% weight of A multiplied by the return in stock A for stock A in the recession state, which is minus 15%. Then we add the weight of stock B in our portfolio, 0.7, multiplied by stock B return in the recession state, which is 90%. And this gives us 58.5%. Next, how would we calculate the expected return on the portfolio, the third column? The word expected always means you must use probabilities. This is what the word expected wants you to do. If you see the word expected, it means you must use probabilities somehow. We have not used them yet when we were doing portfolio return in individual states. Expected means we're doing something that combines different states into one number. So to calculate the expected return on the portfolio, we need to use the probabilities of boom and recession, which are given as 50% and 50%, two equally likely states. So we multiply the probability of the boom state of the economy by the return of the portfolio in the boom state of the economy. Then we add the probability of the recession state of the economy, 0.5, multiplied by the return of the portfolio in the recession state. And we get 5% for the first combination or portfolio of A and B. For the other portfolios, we get 18.5%, 27.5%, 36.5%, and 50%. Then the variance is similar to the expected return on the portfolio, except where we would multiply by portfolio return in that state, we now multiply by squared distance from the 5% portfolio expected return. So for the first combination with 100% invested into A and 0% of money invested into B shares, we do probability 50% of the boom state multiplied by the return of the portfolio in the boom state, 25, minus the expected portfolio return, 5. And that difference is squared, plus the probability of the portfolio in the recession state, 50%, or 0.5, multiplied by the portfolio return in the recession state, minus 15%, minus portfolio expected return, 5. And the difference is squared. This gives us 400. The square root of that is 20. 20% average distance from the 5% expected return in either direction. For all other portfolios of A and B, we get different numbers. So for the portfolio number 2, 70% A, 30% B, the variance of the portfolio is 4 and the standard deviation is 2. 50-50 A and B, the variance is 100, the standard deviation is 10. 30% A, 70% B, the variance is 484, the standard deviation is 22. 0% A, 100% B, the variance is 1600 and the standard deviation is 40. So we have a lot of repetitive calculations here, right? Every row kind of repeats itself, and the only difference between the rows is the weights. So we kind of plug in different numbers for the two weights of A and B, otherwise the rest stays the same. Okay, let's answer a few questions. What is the expected return on just stock A? Well, just stock A is like a portfolio which includes 100% weight of A and 0% weight of B. So the expected return on A is the expected return on the portfolio with just stock A in it, 100% stock A in it. So that's 5%. What's the expected return on stock B? That's a 50% portfolio with just B in it. Expected return on the portfolio. What are the two standard deviations for A and B? First row is just A, so we have 20%. Last row is just B, we have 40%. Next question. Which of these 5 portfolios, 5 rows in this table, is the least risky portfolio? Kind of obvious, the one with the lowest standard deviation or variance, either way. So the one with 70% in A and 30% in B, the standard deviation is 2, right? This means actually something very interesting. And that's the whole reason why I decided to include this example in my slides. It means that there is stock A. You can buy just stock A, which is pretty risky. Your fluctuations will be 20% either above or below the average return you'll be earning every year. If you just buy B, it's even riskier, double the risk. Your fluctuations will be 40% above or below the average return every year. But if you mix the two, you can reduce the overall fluctuations of your portfolio returns. So it's like you mix two risky things, but you don't get something like halfway between 20 and 40. You get something way below the riskiness of each of the individual stocks, right? Are there any portfolios here that you should never be buying? Well, look at, compare the first portfolio and the fourth. They have roughly the same amount of risk, 20% standard deviation and 22%. So they're very similar in terms of how the actual returns on these portfolios will be fluctuating every year. However, on average, on the first portfolio, you'll be making 5% more money in 1 year. And on the fourth portfolio, 30% of money invested into A and 70% money into B, you'll be making a 36.5% return on average every year. So they have roughly the same amount of risk, but you cannot even compare their average growth per year. So the first portfolio should never be in your interest to buy, because portfolio number 1 and portfolio number 5 are very close in terms of the risk, but portfolio number 4 has much higher return. So there may be some portfolios which no smart investor would ever be interested in, but everything else here, like the second, the third, the fourth, and the fifth, they're kind of up to you. Because you can notice how a less risky portfolio, like the one with 2% standard deviation, has the lowest return every year. But the riskiest portfolio with 40% standard deviation has by far the best average return every year, expected return. So, it's this trade-off between risk and return. High risk, high return, low risk, low return. So portfolios 2, 3, 4, and 5 should be what you would be looking at. You will be choosing one of these 4. But the first one should never be interesting to you. You would not be a smart investor if you are even considering, the portfolio number 1. So again, the conclusion is, don't buy just stock A. Your riskiness will be very high. Fluctuations, 20% standard deviation. Don't just buy stock B. It's even higher risk. But buy a combination of 2 risky stocks, because overall, for your portfolio of A and B, the fluctuations in the returns may be much smaller, if you find a wise portfolio. So this is again the advantage of diversifying your investment. Don't put all eggs into one basket. Diversify your portfolio. What's the best way to diversify your portfolio? It's buying stocks from very different companies, or stocks and bonds and real estate. Like putting your money in very, very different things. Because again, just like in the previous problem we had, what's going on in this problem is, the offsetting of losses by gains elsewhere within the portfolio. You never lose money because when you would be losing money on stock A in the recession state, you're gaining a lot of money from stock B in the same recession state. And when the return is low on B in the boom state, it's pretty good in A from A returns in the same boom state. So again, we have sort of inversely related returns. Low returns are offset by high returns, right? So the returns on stocks offset each other. When the return on stock A is high, return on stock B is low, and vice versa. So let's say, here's a question. Should you buy, which portfolio is better? You're buying Google's shares and you're buying Facebook's shares, or you're buying Google's shares and you're buying Target's shares. Your answer should be the second portfolio, Google's shares and Target's shares, because these companies are in very different lines of business. They're not affected by ups and downs in the economy the same way. And so you may be able to buy shares of stock from both Google and Target stock and observe this like offsetting of the returns, which results in your overall portfolio, return fluctuations being much lower than if you just bought shares of stock from Google or just bought shares of stock from Target. So to finish this topic on the diversification effect, the textbook says that diversification is the process of spreading an investment across assets and thereby forming a portfolio. The book also says that the principle of diversification tells us that spreading an investment across many assets will eliminate some of the risk. The key word here is some of the risk. So can we never eliminate the risk completely if we keep adding more and more and more stocks and building a more diversified portfolio? We're going to see the answer to this question on the next slides. In our previous examples, we saw how when we buy just one stock, the risk of in other words, the fluctuations of actual returns may be very large. In other words, we saw a high, we could be looking at a high sigma, the notation for the standard deviation. And we also saw in that example, or actually we had a couple of examples with a portfolio of two stocks in which we saw how we can combine two risky stocks, and as a result, the portfolio standard deviation may be lower than the two stocks' individual standard deviations. And so we can actually keep going like that. We could have an even more complicated problem with three stocks and find a portfolio with such smart weights of the three stocks that would make the portfolio standard deviation even lower. And with four stocks, it can be even lower, right? And so on. Turns out that if you hold a portfolio of, let's say, 100 stocks or even more than 100 stocks, then, of course, as expected, the risk of the overall portfolio may become even smaller. But it will never go down to zero, meaning, so what does zero risk mean? Zero standard deviation of portfolio returns. It means perfect predictability of what we're going to get. In other words, It's exactly the same return every single year, no more, no less, no fluctuations. So it turns out that will never happen no matter how large of a portfolio we are trying to make. And so you can imagine this graph on the horizontal axis. If you move to the right, we are increasing the number of stocks in our portfolio. On the vertical axis, if we go up, we are increasing the amount of risk or the standard deviation of annual returns. So it turns out that as we increase the number of stocks in our portfolio, so graphically we are moving along the horizontal axis to the right, we are going to be able to lower more and more and more the overall portfolio risk. But this line, it's more like a curve. It's going to kind of flatten out, but it will never reach and cross the horizontal axis, because crossing it would mean that we reached zero along the vertical axis. So that can never happen. This is known as the so-called total risk of a portfolio. Now let's talk about how we can split total risk into two components. The first component is the so-called non-diversifiable risk. So that's kind of the level of risk, the minimal level of risk that we are approaching, but never going to be able to go below as we increase the number of stocks in our portfolio. So this is the absolute minimum amount of risk, nothing we can do about. So think about fluctuations in actual portfolio returns that will have to stay. We cannot make them go away. That's the non-diversifiable risk. So diversifiable means something we can eliminate through diversification, through adding more and more stocks to our portfolio. So this minimum amount of risk cannot go away. It's beyond our control. And the one that can go away is called diversifiable risk. So diversifiable risk is in our control. Non-diversifiable risk is beyond our control. This is how we can decompose the standard deviation, which is the total risk of a portfolio returns, into how much of it we can get rid of, the diversifiable risk, and how much of it we cannot get rid of, the non-diversifiable risk. I marked this point along the horizontal axis, 500. So this is the so-called portfolio of 500 stocks, actually largest companies' stocks in this country, also known as S&P 500, which stands for Standard & Poor's 500. So it's like it's also what's known as the market portfolio. And it's because there are 500 different company stocks included in it, it's like representing the market, like how the economy overall is doing. Because 500 largest companies, the value of them is maybe 99% of the value, the dollar value of all companies in the economy, right, in the country. Our market portfolio is actually also the same thing as the so-called large company stocks from Chapter 12, which had an expected return of 12% and the standard deviation of historical returns of 19.9%. So you might remember that orange line on our graph with several jumpy lines over 1925 to 2016, 91-year time period. So market portfolio is the large company stocks, largest 500 companies in the country. So this is kind of what's used as a benchmark. That's the importance of it. The market portfolio, the S&P 500, is a real-life sort of proxy for a very well-diversified portfolio, such that everything that could be diversified away is diversified away, pretty much. I mean, it's pretty much negligible, zero. So the fluctuations in returns on this very large portfolio are those fluctuations in returns that investors have no control over. They cannot further lower those fluctuations to lower the amount of risk. Now let's talk about like what makes something beyond our control, like what is the non-diversifiable risk, as well as let's look at a couple more details on the total risk and both components of it. So the total risk is basically the standard deviation, kind of how we mathematically calculate the amount of fluctuations in some financial security or portfolio, right? Based on the possible returns in different states of the economy. Now, diversifiable risk is the fluctuations that we can kind of undo. Well, not undo, but we can lower them by adding more stocks to our portfolio. There are other names which are used interchangeably, and you should know all of them. Unsystematic risk, unique risk, like unique to some company. Asset-specific risk. Asset refers to some company stock. Firm-specific risk. So what does this tell you? Like, why is it diversifiable risk? Let me give you an example. Let's say a company's CEO dies, right? What do investors, how do investors behave to this news? Well, they're gonna have a lot of uncertainty about who the new company's manager will be, what will happen with the future of the company, how that will affect the investor in terms of like the dividends they will be receiving on their stock shares, right? But, okay, and so it's possible that the returns on this company's stock will may drop if the new manager kind of is not as good as the previous one. But the loss in money on this specific company's stock is unique to that company. So it's not like all other company stock shares that you're holding experience the same drop in returns, right? Because we are only talking about the CEO for this specific company dying. So maybe you lost money on this particular company stock, but you see this offsetting of the loss with gains in the other stocks you have in your portfolio, right? So you can kind of undo firm-specific return fluctuations. Well, not undo, I would say more like you can cancel them out with gains from high returns in other stock from other stocks in your portfolio. On the other hand, the non-diversifiable risk, which is also known as the systematic risk or market risk, and again, you should know all three. All three are used interchangeably, equally often. This is more like fluctuations in returns caused by not some event unique to that company, but more like a countrywide event, a big event, maybe a global event, like the economy falling into recession. Think about something like that. If the country is falling into recession, then all companies are affected to some extent, some more, some less, but all companies are losing money because people are not buying their product as much as they used to. So they're all seeing like losses in revenues, losses in profits, and as a result, they're paying lower dividends to investors and the returns drop, right? So this is something you cannot diversify away because it's not like the loss on some particular company's stock in your portfolio is canceled out by gains on other stocks in your portfolio at the same time. No, at exactly the same time, you see losses across the board in your portfolio. So you have an overall portfolio return drop, right? You cannot sort of get rid of it. So diversifiable risk is caused by our fluctuations in actual returns on some stock within your portfolio that are caused by events which are unique to that particular company. Non-diversifiable risk are fluctuations in returns on a particular company stock within your portfolio which are caused by economy-wide events, something that you cannot offset with gains from other stocks in your portfolio. And this is why, like going back, like maybe 3-4 slides back, we had this statement that the principle of diversification tells us that spreading an investment across many assets will eliminate some of the risk, but not all of it. The type of risk it will not eliminate is the non-diversifiable risk. Now, why is all of this important? It's important because remember this phrase I mentioned several times: high risk, high return. So if you're an investor and if you're buying something that you know is risky, like, right, you'll have some losses in money in some years, but huge gains in other years, then you're only buying something risky because you know you'll be rewarded with a high return. So there is a reward for bearing risk. However, there should be no reward for bearing risk unnecessarily. And what this refers to is the so-called non-diversifiable risk. Sorry, I made a mistake. It refers to the diversifiable risk, or so-called unsystematic risk, that you can eliminate by adding more and more stocks to your portfolio. So you should only be rewarded for the risk that that particular company stock has that is beyond your control. The systematic portion of risk, or the non-diversifiable portion of risk, or the market risk. Remember, there were 3 names. So let's summarize. Since unsystematic risk, or non-diversifiable risk, can be eliminated through diversification, only the systematic portion of risk should be rewarded with a higher expected return. And this is known as the systematic risk principle. So it basically, in different words, the way I would summarize what's on this slide is, when we say high risk, high return, we really mean high systematic risk, high return, rather than high total risk, high return. In finance, there is a way to calculate precisely how much of the systematic risk, the non-diversifiable risk, the fluctuations in returns that are beyond your control, is how much of it is in an asset. We're gonna skip the math, and we're gonna look at just how to interpret the number that comes out of those calculations that we are skipping in this book. So all we're going to say is that the systematic risk has a formula, how it can be calculated, and the formula is the beta. So the beta equals something, which we are skipping. Beta is the notation we use for the amount of systematic risk. So the beta coefficient shows how much systematic risk a particular company stock has. And the important part of the definition is that we are using the market portfolio as the benchmark. So beta captures this comparison of a particular company stock relative to the market portfolio. Remember what market portfolio was? That was a portfolio which is very well diversified, which has practically no diversifiable risk remaining. That's the so-called Standard & Poor's 500 index, which is a portfolio of 500 largest companies in this country. So the benchmark is beta for the market portfolio equal to 1. You can also say that the beta for an average company stock is equal to 1. So 1 for the beta means on average how any company stock in this country fluctuates based on like those type of, caused by those type of events that we call economy-wide or on a global scale, rather than specific to a particular company. So something we have no control over. So on average, the fluctuations that a company has when caused by those type of big events, they are like captured in this beta calculation, and that average fluctuation amount is equal to 1. So let's look at this table where we have different companies: General Mills, Coca-Cola Bottling, ExxonMobil, 3M, The Gap, eBay, and Yahoo. Let's look at a couple of those. Coca-Cola Bottling, the beta coefficient equals 0.65. And then let's also look at eBay's beta, which is 1.35. By the way, betas for all companies are available on websites like Google Finance or Yahoo Finance. They're kind of known numbers. So for eBay, it's 1.35. For Coca-Cola Bottling, it's 0.65. 1 is below 1 for Coca-Cola. 1 is above 1. Below, so all we're going to say is that anything that's below 1 means there is less risk than for the amount of risk observed for an average company in the economy, or for the market portfolio, in other words. So because the beta for Coca-Cola is only 0.65, that's below 1, right? And because of the systematic risk principle, we're going to say that it's less risky when by risk we only focus on the fluctuations in returns that we have no control over. Less risky than the market portfolio. And because of that, it should have a lower expected return than the market portfolio or than an average stock in the economy. eBay's beta is 1.35. That's above 1. So we will say exactly the opposite. It's riskier than the market portfolio, or you can rephrase and say it's riskier than an average company stock. And because of that, it should have a higher expected return. So to summarize, we are saying high risk, high return. And by risk, we mean the systematic risk, or the market risk, or the non-diversifiable risk, which is measured by beta. Okay, let's look at this example. We have two stocks, A and B, and we have sigma and beta for each. The sigma for A is 40%, the sigma for B is 20%. The beta for A is 0.5, the beta for B is 1.5. Question: which stock should have a higher expected return and why? Okay, so you can look at it and realize that the sigma is 40% for A, 20% for B. Sigma is the standard deviation of returns. So stock A returns fluctuate a lot more than stock B returns. And so you may think that it's correct to say that A is riskier, and because of that, A should reward investors with a higher expected return. However, this is a wrong way to analyze this problem, because what is sigma? Sigma is what we mean by total risk. So it's just, fluctuations in returns, on average how far they are from the expected return. But what is the difference between the sigma and the beta? Beta also measures risk, but it's only part of sigma. It's only kind of limited fluctuations, limited to those fluctuations in returns caused by events that are on a large scale, not unique to a particular company like company A or company B, but something bigger like a recession or recovery in the economy that affects both companies in the same direction. This is the systematic risk, right? Or the non-diversifiable risk or market risk. And this is from the previous slides, the so-called systematic risk principle. This is really the only thing we should care about when we talk about high risk, high return, right? So by high risk, we should only focus on the systematic risk. Which stock has a higher systematic risk? Stock B, because 1.5 for stock B is higher than only 0.5 for stock A. And this means that a big part of firm A's firm-specific risk can be eliminated by forming a portfolio. And so what's remaining, the beta of 0.5, indicates that there is relatively very little left in the fluctuations that are caused not by something specific to firm A events, but something specific to other events that affect firm A. Because only the non-diversifiable risk should be rewarded, B with a higher beta should have a higher expected return. Can we calculate beta for a portfolio, let's say 2 or 3 or more stocks? Yes, we can. It's just the weighted average of individual stocks' betas. So the weight of security number 1 multiplied by its beta plus the weight of security number 2 multiplied by beta, and so on. So the number of products in the sum equals the number of stocks in your portfolio. For example, the beta of stock A is 1.5, the beta of stock B is 0.8. And let's say you invest 30% of your money into stock A shares and 70% of your money into stock B shares. What's the overall beta of this portfolio? The beta of the portfolio of stock A and stock B equals the weight of stock A, 30% or 0.3 in decimals, multiplied by the beta of stock A, which is 1.5 given, plus the weight of stock B in the portfolio, which is 70% or 0.7 in decimals, multiplied by the beta of stock B, 0.8, which is given. The math gives us 1.01. What does it mean? How can you interpret this number? It's very close to 1, which is how an average stock returns behave like how big large-scale events affect returns of an average company stock, or we can say the market portfolio, which is a combination of largest 500 company stocks. 1.01 is pretty much 1, so it's barely above 1, the benchmark. So we can say that this portfolio of A and B is just a little bit riskier than the market portfolio. Okay, now that we know that it is the systematic risk measured by the beta that determines the required return, what is the exact relationship between the two, between the systematic risk and the return that correctly reflects the amount of such risk? This is described in this big topic in finance, in corporate finance, known as the Capital Asset Pricing Model, or CAPM, CAPM. Okay, so we're talking about the relationship between risk, systematic risk to be specific, beta, and that's what we put on the horizontal axis, and return, or we're actually going to say expected annual return. So what investors should expect when they are buying a stock or a portfolio of stocks that have a certain amount of this systematic risk. Let's first mark our first point on this graph. The market portfolio. By definition, the beta of the market portfolio is 1. So somewhere randomly along the horizontal axis, we mark a point and we say that it's 1. And then for the market portfolio, with the beta of 1, there is some expected return for it. E, and in the brackets we put R and subscript capital M. M stands for market portfolio, R stands for return, E stands for expected. So we have this point, right? The market portfolio, point M. Then there is one more important point. R subscript lowercase f, RF, the return on the risk-free asset. From our last chapter, chapter 12, the risk-free asset was the short-term government bonds, known as treasury bills or T-bills. Risk-free, in theory, means no fluctuations in return. So perfect predictability of what your return will be in percent every year. So even though in real life, even treasury bills like exhibit a little bit of fluctuations over time, we kind of simplify the reality a little bit and say that the fluctuations are zero, which means the standard deviation is zero as well as the beta is zero. If the beta is zero, then this point, the risk-free rate, belongs on the vertical axis. And because the return on the market portfolio, on the risk-free asset is less than the return on the market portfolio, for example, we saw it in chapter 12 with the treasury bills, return on average being lower than the return on large company stocks. Because of that, the risk-free return is, below the expected return on the market. Then we have 2 points, and we can draw a line through them. In this textbook, we are skipping the explanation and the mathematical derivation that explains why the line needs to be straight rather than some sort of a curve going through these 2 points. So it has to be a straight line. And along this line, we can place all other stocks of all other companies, like Apple and Yahoo and Starbucks, anything you can think of. So this is where all other stocks should be. This is the correct relationship between how much systematic risk that particular asset has and what the required annual return should be that correctly reflects that amount of systematic risk. You can notice that the line slopes up and to the right, which means we are talking about the positive relationship between systematic risk and required return. And this is what you should have expected because of this phrase, high risk, high return. So the higher the beta, the higher the expected return. Okay, now let's talk about some math. So this is the equation for this CAPM model. The vertical intercept. So how do we calculate the expected return on any stock? So let's say stock I. The expected return on stock I equals, so what's the equation for a straight line? Vertical intercept, that's the risk-free rate, plus the slope multiplied by the beta, right? So the slope of the security market line turns out to be the difference between the expected return on the market portfolio and the risk-free rate. The name for this line is the security market line, or SML. That's the abbreviation. What else can we say about this graph? Along the vertical axis, we marked 2 points earlier, the expected return on the market and the risk-free rate. The difference between the two, whatever that is in percent, is the market risk premium. It's actually by definition. It's the risk premium on the market portfolio. By definition of what risk premium means, which we saw in our previous chapter. And for any other company, so let's say we have point I somewhere higher up beyond point M for the market portfolio. For any other company, we can calculate its risk premium by looking at the difference in percent between the expected return for that company, stock, and the risk-free rate. Let's look at a typical problem on this CAPM topic. We have a firm called J. The stock of it has risk measured by beta. So beta subscript J equals 1.6. It's given. The risk-free rate, which is the return on the treasury bills, is 3.8%. The expected return on the market portfolio is 12.3%. Let's calculate two things. One, what annual return should correctly compensate investors for such risk? This question could be phrased differently. What is the required return on firm J's risk? And the second question is, what is the risk premium on J's stock? Let's start with question number one. We look at the CAPM formula, which is what we need to use to calculate the expected return on firm J stock. And we plug in all the numbers that were given. The risk-free rate, which appears in two places in the formula, is in decimals 0.038. The beta is 1.6, and the expected return on the market portfolio was given as 12.3%, or 0.123 in decimals. The calculations give us 17.4%. The second question is, what is the risk premium on J's stock? By definition, the risk premium is the expected return minus the risk-free return. So we take the answer from the first question, 17.4%, and subtract the treasury bill rate, 3.8%, which was given, which gives us 13.6%. Okay, where are we on our CAPM graph? So we started with the beta for firm J stock being equal to 1.6, right? So that's to the right from the point that means the market portfolio. And so we should have a higher return than the market portfolio return. And that's what we calculated in question one using the CAPM formula. So 17.4% is the expected return on stock J. Then in the second question, we were asked to calculate the risk premium. That's the difference between the return on J stock and the risk-free return, 3.8%. So it's this difference, the 13.6% difference. So just, a refresher on what risk premium means. It's how much additional return an investor earns above the return for treasury bills. So treasury bills is like a benchmark. And we earn 13.6% better return if we buy something riskier, like firm J stocks, rather than something completely risk-free, which is the treasury bills. Okay, then let's look at this graph again. What if we are given some information on a company stock? We know the beta, we know the return on it, and we realize that the return is actually higher than the return that would be on the security market line, right? So what if we have a company whose stock has a combination of beta and expected return that lies above the line? When a stock lies above the security market line, it means that the return is better than it should be for this amount of beta, systematic risk. Is it a good thing for investors? Of course, because they're paying some money to buy each share, and they're compensated more than they should be compensated for the kind of, fluctuations in returns that they're getting with their purchase. So this stock will be very popular in high demand. And high demand means the price will rise. If the price rises, then eventually things will stabilize, because you will be paying more money today, and everything you get in the future, like the dividends, will become sort of a lower percentage of what you paid, which is how we calculate the return. So the return will drop, and graphically, the return dropping means we're moving down, straight down, towards the security market line. And eventually, the market will sort of stabilize itself, and the price will rise high enough to make the return fall low enough so that the point reaches the security market line. And this is where the kind of the market equilibrium will occur. And so the fact that currently the stock has a better return than it should implies that the price is too low. And we say that this stock is currently underpriced. So above the line, underpriced. And the opposite will happen if the information we are given indicates that a company's stock lies below the line. This is when everything is reversed. The investors are compensated inadequately for the amount of systematic risk or fluctuations in returns that cannot be controlled by the investor. Right? So they are not compensated enough for the amount of risk that they are accepting when they buy these companies' shares. And that makes the stock kind of unpopular. The price will drop so that investors get interested in buying the stock. If you pay less for the stock now, then everything you're getting on the stock later in the future, like the dividends, mathematically will mean a higher percentage of what you're paying for the stock now, which is exactly how we calculate return. And so that means that as the price starts falling, the return starts rising. And graphically, the point that was under the security market line will start climbing up and slowly reaching the security market line. And the equilibrium occurs when the point is exactly on the line. So for this amount of beta, we have the right compensation for it in the form of expected return. And so the fact that currently the price is too high and will need to fall, it means that this stock is currently overpriced. So to summarize, any point above the line means the stock is underpriced. Any point under the line means the stock is overpriced. Okay, what else does the security market line tell us? So we can basically place all company stocks somewhere along this line. This is the correct pricing. So the price per share stock is correctly reflecting the combination of risk and return that you will be getting when you buy the stock. So what else can we say about this line? All the securities that you see, so let's say the risk-free asset, the market portfolio, stock I, stock J, stock K, and so on, they all have the same slope. Kind of pretty obvious, right? Along the same line, the slope is the same. The slope of the security market line at any point is the so-called reward to risk ratio. So we are saying that the slope being the reward to risk ratio is the same. What do you mean by the reward to risk ratio? Let's imagine this triangle. On the left, it starts at the risk-free return. Then one side of it is the diagonal side of this right triangle, which kind of goes along the security market line. And then let's say, we pick some stock, let's say stock J. So from point J, we go straight down, and then straight to the left so that we have this, right angle, 90-degree angle. And so the third line, it kind of ends where we started, at the risk-free rate. So we have the so-called right triangle with a 90-degree angle, and the diagonal side across the right angle being basically part of the security market line. So what is the slope of the security market line, which is kind of the corner where we started at the risk-free rate? By definition, it's rise over run. Rise, the vertical side on the right, divided by run, the flat horizontal side of this triangle. What is the run? The run is basically the risk, right? Because we're measuring the amount of beta. So it's the beta for this company J, which we use to draw this triangle. What is the rise of this right triangle? It's what we call the reward, the risk premium for firm J's stock, the return above the return for the risk-free asset, the difference, right? The expected return on firm J stock minus the risk-free return. Okay, so the slope of this right triangle is rise, or the reward, or the risk premium, divided by the run, which is the risk, or the beta. And because at any point of along this line, so we can start not at the risk-free asset at which we measure the slope, but at the market portfolio point or stock I point, and so on. But at any point, the slope is the same, which means every point, every stock along this line has the same reward to risk ratio. So for example, we could draw a triangle which starts at the risk-free rate and then ends at point M, and then goes straight down to form the right angle. Or it starts at the risk-free asset, goes diagonally along the security market line and stops at point I and then goes straight down, or point K. So all these triangles will have the same slope. And you can kind of think of this whole slope being the same like intuitively. What does it mean? It means that for any stock, for an additional amount of beta, the required additional risk premium is always the same amount. For example, if the beta doubles, the risk premium also doubles, right? So you double the risk, you double the reward. Let's look at this example. Consider an asset with a beta of 1.2, a risk-free rate of 5%, and a market risk premium of 8%. Question number 1, what is the required return on the asset? Question number 2, what is the reward to risk ratio for this asset? Let's start with question number 1. What is the required return on the asset? This is, the CAPM formula. So first, let's put everything we are given on our CAPM graph. We have the risk-free rate of 5%, that's the vertical intercept of the security market line. We have the market portfolio, kind of always by default, with a beta of 1 and some expected return. And we have our asset with a beta of 1.2, which means our asset is further up along the security market line, beyond the market portfolio point. So we place the beta of 1.2. And now let's use the CAPM formula, which says risk-free rate plus beta multiplied by, open parentheses, expected return on the market portfolio minus the risk-free rate, close parentheses. The risk-free rate is 5% or 0.05 in decimals. The beta is 1.2, it's given, and we multiply that by 0.08. So why did I not subtract the risk-free rate of 5%? Because the market risk premium is the difference between the expected return on the market and the risk-free rate. So we are given the entire term in the parentheses in our formula, rather than just one part of it, the expected return on the market. So wording is important. Market risk premium is not the same thing as the expected return on the market. The expected return on the market is E and in the brackets RM. The market risk premium is E in the brackets RM minus RF. So market risk premium of 8% is the number for the entire parenthesis term in our CAPM formula. When we do the math, we get 14.6%, and we can label our expected return for this stock on on this CAPM graph. And then we have the second question that needs to be answered. What is the reward to risk ratio for this asset? Let's calculate the reward. Let's calculate the risk and then divide the reward by risk, which will give us the reward to risk ratio. What is the reward? Reward is basically the risk premium. So we take the return, we calculate it from step 1, and we subtract the risk-free rate of 5%. So the risk premium, which is the reward, equals 14.6% minus 5%, which gives 9.6%. And on the graph, that's the distance between the expected return on our stock and the 5% risk-free rate along the vertical axis. Now let's calculate the risk. Risk by definition is nothing but beta. No need to calculate anything. The beta is given, 1.2. Okay? Reward to risk ratio is reward divided by risk. So we take 9.6% and divide by 1.2 and we get 8%. Now notice something interesting. We were given the market risk premium of 8% and we have just calculated the reward to risk ratio for our asset, which also equals 8%. Is that a coincidence? No, because the reward to risk ratio for the market portfolio is the reward for the market, which is given 8% risk premium, divided by the beta for the market. What is the beta for the market? It's always 1. So 8% divided by 1 is 8% reward to risk ratio. In other words, the market risk premium is the same thing as the reward to risk ratio for the market portfolio. And so technically, you don't even need to calculate anything to answer question 2, because the reward to risk ratio is the same for all assets lying on the security market line. We had it on one of our last few slides. And so because the market risk premium is the same thing as the reward to risk ratio for the market portfolio, you could take this 8% and use it for your answer to question number 2. No need to calculate the reward for our stock, the risk for it, and then take the ratio. It will always equal the reward to risk ratio for the market or the market risk premium. Let's summarize. Let's summarize in the form of a quick quiz. How do you compute the expected return and standard deviation for an individual asset? The expected return for one stock is the probability of the first possible state of the economy multiplied by the return if that state of the economy occurs. Plus, you do the same product for the second state of the economy. Then you add the same product for the third state of the economy. And you keep doing that until you have covered all states of the economy. The standard deviation for an individual asset is actually kind of the same thing, except where you would be multiplying the probabilities by the return in that state. You now multiply the probability by the squared difference between the return in that state and the expected return. For a portfolio, it's actually kind of the same thing, except you need to first calculate portfolio return in each step. So it's a little bit more technical work involved. Second, what are the differences between total, systematic, and unsystematic types of risk? Total risk is fluctuations in returns for some company stock caused by any kind of events. Systematic risk is fluctuations in returns for some company stock caused by economy-wide events, something that an investor has no control over. Unsystematic risk is fluctuations in returns caused by company-specific events. This is something that the investor does have control over. And what we mean by that is we can cancel out any low returns of this type, caused by sort of unsystematic events specific to the company. We can cancel them out with gains from other stocks in our portfolio. So we can control the unsystematic fluctuations in stock returns by forming a large enough portfolio, by adding stock number 2 of a different company, stock number 3, company number 3, stock number 4, and so on. And for a large enough portfolio, you'll have a lot of canceling out of low returns going on, so that you can basically have control over those type of fluctuations. And the last one, what type of risk is relevant for determining the expected return? It's only the risk that will always remain, the so-called systematic risk, or the other names for it were market risk or non-diversifiable risk. So the higher the non-diversifiable risk, the higher the return that investors should expect from the stock. And that's because the unsystematic risk can be eliminated by the investors themselves. So there is no reward for bearing risk unnecessarily.